Hello and welcome to Livewire's Buy, Hold, Sell. My name is Chris Conway. US earnings season has all but wrapped up, so today we're going to take a look at the season that was, with a particular focus on the small and mid-cap space. To help me do that, I'm joined by Michael Poulsen from Canopy Investors and Nick Markiewicz from Ellerston Capital. Gents, we've got a lot to cover, so I'm going to dive right in. The big question first up, did earnings season live up to expectations? Michael, I'll come to you first.
So Chris, I'd say that there were some cross currents for us this quarter. On the one hand, we have more trade and tariff certainty, a little bit more, which is positive. There's obviously also a lot of capex spend that's going in the US, particularly around data centers and AI, which is helping economic growth. Those are the positives. On the other hand, there is still actually quite a lot of policy uncertainty remaining in the US. We talk to manufacturers or industrials companies or chemicals companies, and in some instances, they are delaying or deferring investment until they feel as though they've got a bit more clarity. On the consumer front, the picture's also a little bit mixed. If you're a high-income consumer, you might own your own home and have an investment in the stock market. Spending has been more resilient. Lower income and younger consumers are struggling. So mixed.
Nick, what about you?
Well, I think at a high level, reporting season that's just been was probably a success, at a 30,000 foot level. Corporate earnings were very strong. I think EPS growth at a aggregate level for the S&P 500 was 15%. Corporate profit margins are at the highest level in 15 years as well. So companies at a headline level are in rude health. But it's a very much a bifurcated market. It's the haves, the have-nots by different sectors. So if you're in the sectors that are growing, which is AI and a few others, earnings were very good. And if you're in a sector that's been struggling, then earnings were poor. One thing that I think that did surprise me this reporting season was just the reactions to the different results. Earnings beats were met with sort of half the usual upside, and earnings misses were met with twice the usual downside. So huge volatility, and in the small mid-cap land, that volatility was even higher. So a big set of outcomes.
Yeah, Nick, I'll stay with you. You touched on a few of them there, but let's go a little bit deeper. Some of the highlights of the season for you.
The highlights was really just AI. I mean, if you're not in AI, I'm not sure you're anywhere in the current market. I mean, maybe I would have said that 2 weeks ago. The last 2 weeks has been a little bit different. But, what we're really seeing is the capex spend from the hyperscalers, which is the large, the Mag 7, or most of the Mag 7. That capex continues to be upgraded. And you can argue whether that's a good thing or a bad thing for the Mag 7. But for the rest of the AI ecosystem, the Mag 7 capex is their revenue at the end of the day. And so that's getting upgraded still. One of the advantages we have being a truly global investor is that we look at the AI supply chain all through Korea, Taiwan, Japan and China. And the comments from all the suppliers there points to a very rosy picture for 2026 as well. So definitely AI being the big bright point, but also banks and financials had a great set of numbers as well, just on higher trading numbers, deal flow and loan growth as well.
Michael, some highlights for you?
Well, I'll talk about healthcare. We have a couple of service providers to the healthcare industry in the US. US healthcare has actually been quite weak over the course of the last 18 months, and that's for a few reasons. Large pharma companies have some blockbuster drugs that are rolling off. The biotech funding environment has been more difficult in the post-COVID period, and there's also just been a lot of policy uncertainty around what Trump was going to do and what RFK was going to do. The highlight is we're starting to see a little bit of stability returning. So large pharma companies are starting to invest again, M&A and licensing and so on. And biotech funding looks as though it's starting to begin to improve. So those are positive factors.
We've done the fun stuff, gents, the good stuff. Now let's talk about some of the lowlights. Michael, I'll stay with you.
So there's a couple of sectors that I would call out to begin with. One I've alluded to, and that's just the bifurcation in terms of the US consumer, particularly lower income and younger consumers. So a couple of examples, Dollar General, which is a discount retailer in the US, it caters predominantly to lower income and more rural consumers, has said that it's starting to see evidence of consumers running out of money at the end of the month, even for basic essentials, which is obviously not great. Chipotle, which is a large quick service restaurant in the US, has also said that it's seeing some evidence of macro issues among its low and middle income consumers, eating at home as opposed to eating out, that sort of thing. The other area that I would call out is in US housing. So the US housing market has been weak as a result of higher mortgage rates for a little while. We had seen some indications maybe in the middle of the year that things were starting to improve. It's now looking as though that recovery is going to take longer to play out.
Nick, what about you? Some of the lowlights from the season?
Look, I just echo a lot of what Michael said. I think we've seen anything touching the US real economy has actually been quite sluggish. I think most companies, we're now seeing a lag effect from the tariffs and the uncertainty there and how that sort of transpired into their investment decisions. So anything outside of AI, capex has been quite weak. US PMIs are still below 50. And so we're seeing that manifest in, everything from, weaker waste volumes, poor housing starts, and low capex for corporates outside of AI, as I mentioned. So some really disappointing numbers there. And also, the retail side, particularly on consumer staples, was not very encouraging as well.
Yeah. Nick, let's talk about where the rubber meets the road. After all of that, any change in your US exposure, or have you bought or sold anything off the back of the season?
No major changes. I think we're sort of waiting and watching. What I would say is that there's a lot of actually really, really high quality names that have maybe hit a bit of a stumble or a speed bump. And we've actually seen quite large deratings for those companies, whether it's just earnings slowed slightly or their multiples were maybe a little bit too high. But certainly we're now looking at far more of these, previously quality compounders that were very heavily owned. They're starting to look quite interesting. I mentioned builders being a point of weakness, but builders actually are now starting to look interesting to us. The home builders in the US are now trading on GFC style multiples, which I think is quite extreme given they're far better businesses today. They've got great balance sheets and housing starts at some point will improve if rates keep coming down. So look, there's certainly pockets of interest, but we're sort of waiting and seeing.
Michael, same question for you. Any movement off the back of the season that was?
Yeah, not a huge amount, Chris. So we're bottom-up stock pickers, long-term investors. So we tend not to make significant portfolio changes based on relatively shorter-term moves, unless there's been a change in our thesis or we're seeing opportunities to improve the quality of the portfolio. I would echo what Nick said. We are seeing a lot of opportunities in quality companies that have been, when the baby's been thrown out with the bathwater, quality companies are on sale, both in the US and internationally, and so we're finding some good opportunities to add.
My favourite part of any buy, hold, sell episode, we're going to talk about some stocks now. I've asked the gents to bring along a stock that did very well for them in their portfolios during the season. Michael, I'll stay with you. What's one that shot the lights out?
Medpace is the company we've got an investment in. That's one of those US healthcare services companies that I mentioned earlier. It effectively helps smaller biotech companies run their drug trials. It's got an amazing long-term track record, founder-led. In mid-2024, it went through a more difficult period. There were some cancellations among biotechs of drug trials because they couldn't get funding to run the trials. And so that led to a period of weak new business ads. 2 quarters ago, cancellations returned to normal levels, and it had a really big beat on new business growth, and so the stock did plus 50 the day after that result. This most recent quarter was a continuation of that trend. So cancellations at low levels, another a big new bookings beat. The stock has run since then. Given that the environment is improving, we're still happy to hold it though.
So Medpace for you. Nick, bring us home. What's one that did well for you during the season?
Yeah, so we own a small Canadian apparel retailer called Aritzia. They make women's clothes for formal wear, workwear. That company shot the lights out. So they beat earnings expectations by 40%. They doubled EBITDA year on year. What was most pleasing was they did a 22% comp, so same-store sales of 22%. I think it was probably the best performing US apparel business that quarter. Most pleasingly for us, they actually maintained their EBITDA margin guide for the year, and that was a bit of a surprise given everyone thought there'd be some impact from tariffs. So a really nice set of numbers. We're really happy to keep holding it here for a few reasons, but one, we think that the nice set of numbers they just delivered is probably likely to continue. They're sort of early in their US store rollout, and when you get a good concept that's tried and tested in their home market of Canada, and you roll that out across new states, that's generally a pretty good recipe for further growth. They actually just launched a new app, which we think is going to help aid that growth as well. Their new app was actually the #1 most downloaded e-commerce app on the App Store in the week after its release, and it was actually the 3rd most downloaded app in total on the App Store. So I think that bodes quite well. And then I would say too that they've been doing very well in a sluggish consumer market, which we mentioned before. And so if there is an improvement in the consumer, tariffs come off, we think that's further upside as well.
There you have it, ladies and gentlemen, Aritzia and Medpace. Thanks to the gents for participating in this episode. If you enjoyed it, make sure to give it a like and don't forget to follow our YouTube channel. We're adding lots of great content every single week.